Have you ever received a tax return and wondered, what should I actually do with this money? It's tempting to splurge on something fun, but what if you could use it to set yourself up for long-term financial success instead? Welcome back to Empower and Thrive. Today, we're talking about smart ways to invest your tax return and any lump sum you might receive. Whether it's a tax refund, a work bonus, an inheritance, or another windfall, putting that money to work can make a big difference in your financial future. We'll explore different investment strategies, break down the best options based on the amount you have, and help you decide what makes the most sense for you. A tax return might feel like a bonus, but it's actually money you earned and overpaid in taxes throughout the year. Instead of letting it sit in your bank account or spending it impulsively, consider using it strategically to build your wealth. I know that is easier said than done, but it's all about learning from your choices. I still remember the first time I got a decent tax return back in college. It felt like free money, and I was torn between doing something responsible, like investing it, or booking a trip to Bali with my mates. At the time, the idea of sitting on a beach with a cocktail won out, and off I went. No regrets, but looking back, I can see how that money could have grown if I'd put it into something smarter. Ever since then, every tax refund I've received has gone straight into investments, and it's been worth it. If you're considering investing, there are 3 common approaches: investing the entire lump sum right away, dollar cost averaging over time, or waiting and buying the dips. Each of these strategies has pros and cons, and understanding them will help you make an informed decision rather than an emotional one. Let's take a closer look at how each strategy works and what to consider before choosing the best fit for you. Option 1. Lump sum investing. Investing your tax return as a lump sum is often the most financially optimal choice. Historically, lump sum investing outperforms dollar cost averaging 65% of the time. The reason is simple: the sooner your money is in the market, the sooner it can start compounding. Markets tend to go up over time, so delaying your investment can mean missing out on potential gains. Of course, putting all your money into the market at once can feel nerve-wracking, especially if you're worried about investing right before a market downturn. This is why many investors consider option 2, dollar cost averaging. Dollar cost averaging involves breaking up the lump sum into smaller portions and investing it at regular intervals over time. The appeal of this strategy is that it can help smooth out market fluctuations. You buy more shares when prices are low and fewer when prices are high. However, while it feels safer, research has shown that it's usually suboptimal compared to lump sum investing. In fact, a study comparing all 3 of these strategies across multiple stock markets found that the loss of dollar cost averaging was around 0.38% annually, a cost that adds up significantly over time with compounding. Option 3. Buying the dips. Another approach that some investors take is waiting for a market dip before investing. This strategy, known as buying the dip, can feel logical, but it's risky. Markets don't move predictably, and by waiting for a drop, you could miss out on significant growth. Research shows that trying to time the market usually results in smaller returns than simply investing as soon as possible. Even in cases where the market was at historically high valuations, lump sum investing still outperformed waiting for a drop. The way you choose to invest can often depend on the size of your tax return. Let's break down some possible scenarios based on different tax return amounts you may receive and how they can be invested wisely. If you receive a $1,000 tax return or less, this could be an excellent starting point for an investment portfolio. You might consider investing in a broad market index fund or exchange-traded fund ETF, which provides diversification and long-term growth potential. If you're new to investing, many investment firms offer free advising services for clients. Additionally, if you don't have an emergency fund, you might allocate a portion of this return to a high-yield savings account for added financial security. For a $1,000 to $5,000 tax return, you have more flexibility. You could allocate some to stocks, bonds, and ETFs for added diversification. If you have high-interest debt, such as credit cards, you might also consider paying some of it off while still investing a portion of your return. You could also use some of this money to contribute to a retirement account, such as an IRA in the US, to take advantage of long-term tax benefits. You can still invest in stocks, bonds, ETFs within your IRA account. If you are fortunate enough to receive a $5,000 tax return or more, you have even greater opportunities to put that money to work. Beyond investing in the stock market, you might consider maxing out your retirement accounts, such as a 401k or IRA, or using it as a down payment on a mortgage if that's in the cards for you. Another smart option is investing a portion of this on yourself. That could mean taking courses to advance your career, earning certifications, or attending industry conferences to expand your network. If you have high interest debt, using a portion to pay it down can free up more money for future investing. Whatever option you choose, focusing on long-term growth can turn a single tax return into lasting financial progress. While the option of lump sum investing is often the most profitable option, the idea of investing your tax return all at once may make you uneasy. That's understandable. The key is to assess whether your hesitation is due to short-term fear of the economy or an indication that your investment choices might be too aggressive. If the market feels too risky, consider a more balanced portfolio that aligns with your risk tolerance rather than delaying or skipping your investment altogether. The other options may not be as profitable, but they beat not investing at all. Find what works best for your amount and your risk tolerance. The most important thing is to avoid analysis paralysis. Getting stuck in indecision can mean missing out on valuable time in the market. The idea is to pick something and move forward with your choice. Beyond investing, there are a few personal finance fundamentals to keep in mind. First, before investing, make sure you have an emergency fund with at least 3 to 6 months' worth of expenses. Second, if you have high interest debt, consider paying it down before putting your tax return into investments. Third, always make sure your investments align with your long-term goals, whether that's buying a home, retiring early, or achieving financial independence. At the end of the day, the best strategy is the one that works for you. Investing a tax return or any lump sum is an opportunity to build financial security, and the sooner you put that money to work, the better. Whether you choose to invest immediately, dollar cost average, or adjust your portfolio to feel more comfortable, the most important step is taking action. The longer your money is in the market, the more time it has to grow through compounding. If you want to grow your wealth, don't let fear keep you on the sidelines. Thanks for watching, and until next time, keep thriving.